So, a new book, a new day, and today's going to be about The Intelligent Investor by Benjamin Graham. Yeah, there's going to be more after the intro, so stay tuned, and I'm going to see you afterwards. Bye-bye. Well, actually, bye-bye might not be that right, but now we see each other once again. So, hello, welcome back to the next episode of the Self-Development with Tactics podcast, and I'm truly looking forward to going through this one, because I also believe that it is not just something that I'm interested in, and it is not also something that other people are interested in, but I think it is just in general something that's quite important maybe to know about. What I know about this book is that, for example, Warren Buffett said that it has been or is one of the most important books that he has ever read. And I think this just has to say something. And I mean, I could also look that up. Warren Buffett, The Intelligent... Is it called Intelligent Investor? I've written it just so poorly. Warren Buffett, The Intelligent Investor. Warren Buffett on The Intelligent... Yeah, as far as I know, it is the case. I thought that I would be able to find a quote really quickly. But anyway, and it is again brought to you by the paulminus.com site. So yeah, yesterday I've actually started, and because you've seen the tab just in a really millisecond, I started another book. And after I've edited it, and after I've just actually written the description, after I've done the thumbnail and everything, so I could be uploading it today, I thought it's not the right time for this one. I think, because it's actually mainly because of the title, and I would have to censor it and not mention it all the time, because the title is in a way somehow you can't just draw some lines between the title and also some things that are going on at this point in time in the world, and I do not really want to just have that quite. I actually don't know why. It is not such a big deal and it's not such a big thing, but I just don't feel right pushing that out, and I just don't feel right than publishing it this as well. But I thought about the vlog that I've edited like a month ago or something, and this is then going to be uploaded, which actually is a funny thing. Like, there's also one episode that I know that I've recorded and never edited and never just done anything with it. It's just laying around on my HDD that's unfortunately broken. Therefore, I have to format 900 gigabytes, which is not nice, especially if you're not having a second hard drive. Well, anyway, The Intelligent Investor by Benjamin Graham from the Paul Minus site. And I'm as always going to highlight everything so that you can have it as a free PDF after I've finished with it, probably. Through arguments, examples, and practical principles, The Intelligent Investor aids the readers to establish the proper mental and emotional attitudes toward their investment decisions. It will show you that a credible result can be achieved by the lay investor with a minimum of effort and capability. Is capability referred to capital? Because as a word, it's not, but yeah, anyway. So who is this book for? The purpose of this book is to supply in a form suitable for layman guidance in the... What's a layman? I don't know what a layman is. See lay person. A non-ordained male member of a church. Okay, guidance in the adoption and execution of a successful investment policy. This book is not addressed to speculators, those who trade daily in the market, and it doesn't aim to show you how to beat the market. It's probably going to be about quote-unquote smart investments, quote-unquote smart investments that will yield some benefits, some profits over 50 years or in 50 years. About the author, Benjamin Graham was... Benjamin Graham was an American economist and professional investor. It's professional. Graham is considered the first proponent of value investing. Warren Buffett, who credits Graham as grounding him with a sound intellectual investment framework, described him as the second most influential person in his life after his own father. I do, by the way, find that pretty interesting, and I'm going to highlight that because I think it is amazing. I do find it pretty interesting that a lot of people are concerning their father to be a very, very influential and also important person in their life. For me, it's actually quite not. Without kind of just being like, well, I've had a bad father and shit like that. No, having an amazing life. I really am fortunate that I'm in a position that I am, and I'm so grateful for that. But I just find it pretty interesting. I just find it pretty interesting and also really cool. If it is a person that is so close to you or was so close to you, and I think that's amazing. I think that's actually a cool thing if this is then actually the case, kind of. So in the summary, it's the same text once again. Anyway, the book summary. So who is an intelligent investor? ? Let's start with there's something that's bothered me quite a bit, and it's my carpet. That's not as it should be. So let's start with the most important question. Why invest? Because of inflation. It takes away your wealth, or our wealth, specifically about 3% per annum, so per year, I'd say, and it is so easily to overlook. And this is something that I've also been reading about because I've also been interested in investing in terms of what should I do with my money? Should I have it laying around in my bank? Should I have it in stocks? Should I have it in whatever? And then I've also just came across there's inflation, and I knew about inflation before, but other people talking about it in terms of if you're having everything just in your bed, the inflation is gonna come and it's gonna fuck your money basically, kind of, and if you're investing in it, then it is just you're going around the whole inflation thing. Basically, those with a fixed dollar income will suffer when the cost of living advances, which is the case almost yearly, as they say, and the same applies to a fixed amount of dollar principal. Holders of sound investments, on the other hand, have the possibility that a loss of the dollar's purchasing power may be offset by advances in their dividends and the prices of their investment portfolio value. So this is the reasons, or the reason, as we can see. And I do want to highlight it, please. Thank you. So what exactly does Graham mean by intelligent investor? It simply means being patient, disciplined, and eager to learn. You must also be able to harness your emotions and think for yourself. Really important. And I think, and this is also one of the reasons why I wanted to go through this book, I guess that those principles can also be translated into other areas of life. Like being patient, really important, really, really, really important. I mean, if you're trying to build something, whether it is a family, whether it is a business, whether it is a house, it's going to take some time and we should be patient. And this is also just a note for me, because I also tend to just be impatient sometimes. And yeah, let's be patient. Let's both be patient, you and me. Disciplined and eager to learn. Yeah, all of these things are incredibly important, I would say. No matter how careful you are, the price of your investment will go down from time to time. You can't eliminate that risk. You can only manage it and get your fears under control. Probably. Yeah, you can't eliminate risk, but you can control it. If this is something that he said or not. But this is definitely something that I've also been thinking about lately. Because I've realized something. Some time ago, I've always thought about should I take this train that is maybe gonna be delayed because it's often been delayed, or should I just take this other train that is slower, but I know that it is gonna be just pretty accurate in terms of it's not gonna be delayed, it's gonna arrive at the time it should be arriving, and all those things. And I always thought maybe I should take more risks, because higher risk, higher reward. And it is definitely also the case. If I can take the risk, and if I'm taking the risk to take the other train or go for the other train that might be delayed, and it is not delayed, then I'm definitely going to be earlier at the place that I want to be, so at my destination, than when I would just take the other one. The problem is, I think it is about mitigating risks. And this is definitely also something that Warren Buffett talked about. Being risky is just pretty dumb, actually. Especially if it is something that you can't calculate, I would say. But if you know that the risk isn't that high, then going for the risk might be okay, you can do that. Just tiny bit of risk. But it shouldn't be 50-50, like it is with the train. Could be delayed, or it could also not be delayed. Who knows? Quite, not really, but quite. So I thought, well, I think it is actually smarter to take the slower train, but this one's 90% is going to arrive at the time it should be arriving, or it should arrive. I think it is smarter, kind of. But I don't know, what do you think about it? I would be really interested in that, so please hit me up or just write it down in the comments. but I would really be interested in that. So in other words, an investor's chief problem and worst enemy is likely to be their own self. That's why Graham constantly emphasizes 3 things. Being your own being your own problem is actually a huge thing. The first one is how you can minimize the odds of suffering irreversible losses, which is definitely also something that, for example, Jeff Bezos is also talking about. If there is something that is irreversible, then you really have to take your time and think about what should you be doing. But if it is something that's easily reversible, and if it is something that's also cheap to reverse, then you can just try to be as fast as you possibly can with the decision, because chances are really high that you're going to be right and that everything is going to be okay. But if it is not okay, then it is going to be 1 step or 2 steps, and then you have to reverse it. It's a little bit more work, of course, but for the sake of being faster, which is definitely something that seems to be quite important nowadays, as also Bezos said, yeah, go for that. Go for being faster, if it is about something that is easily reversible. How can you maximize the chances of achieving sustainable gains? And the last one is, how can you control the self-defeating behavior that keeps most investors from reaching their full potential? I think pretty cool ones. Pretty cool ones. The first principle intelligent investors have to learn is that stocks become more risky and not less as their prices rise, and less risky as their prices fall. Really? I try to think about it. I'm not a big investor, and I also don't really know if I'm ever going to invest into stocks as such, especially if I think about buying something like the S&P 500, which is like, I think it's 500 different stocks in one stock, basically, as far as I know. The problem that I'm having with that is an ethical one, because I don't know what the companies are gonna do with my money. Like, if it is a startup and I can give my money to them, and if I'm just really like, if I just know what they're gonna do with that, I'm gonna be fine with it, And it is also fine for me, and I also find it a pretty cool thing to also use money and whatnot. But if it is like I don't know, Fortune 500 or Fortune 100, I guess, there's also like a really, really fucking big corporation, then I don't know what they do. And I kind of just also think that I might be doing some things that I do not really want to do with my money, or I do not want to basically support with my money, kind of. So yeah. The intelligent investor dreads a bull market when it goes up, since it makes stocks more costly to buy. What does dreads mean? It's not going to buy. Fear a bull market when it goes up. Conversely, you should welcome a bear market when it goes down, since it puts stocks back on sale. Yes, definitely. And this is also one of the reasons why buying stocks when the stocks are really low is a good idea, because there is, like, of course, they can also be lower, but they're probably going to go up once again, So yeah, so if you have the money, of course. And therefore, just having some money is also important, I guess. Not in stocks, but also just quote-unquote cash, or just in your bank account, I would say, so that you can actually be liquid and buy those stocks then, if they're just at a really low price, and also just buy an entire company if the economy is really breaking down, which is something that, for example, Gary Vee is sometimes talking about that it is his plan, to just amass a certain amount of money, which he's definitely doing. His net worth is quite high. It actually doubled, as far as I know, from last year to this year. It's been on 100 million as Tim Ferriss actually is, which is something that's pretty interesting. As an author, podcaster, and also investor, which is the biggest portion, as he said, of his net worth, having the same as an entrepreneur, like full-time and also like whatnot. But yeah, we see it has changed. Graham's margin of safety concept helps. By refusing to pay too much for investment, you minimize the chances that your wealth will ever disappear or suddenly be destroyed. Too much for investment. Yeah, if it is too much, you're not going to buy it. Like, it is a safe system, but I don't know. There are just not also downsides of that as well. There probably are. Like, there are always downsides most often. It is also important to notice Graham uses the term investor in contradistinction to speculator. People who invest make money for themselves. People who speculate make money for their brokers. Okay, the more I know. An investor operation An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. And I do want to point out, upon thorough analysis, promises safety of principal and an adequate return. This is an investment. Maybe this is just like the ideal one, I'd say, or the one that you should be taking, and not the ones that you're gonna just lose money cause of. Operations not meeting these requirements are speculative. Yeah. In the rest of the summary, we'll explore two types of investors. The first one is the defensive or passive investor. They seek the avoidance of serious mistakes or losses and aim at freedom from effort, annoyance, and the need for making frequent decisions. The enterprising or active or aggressive investor, they are willing to devote time and care to the selection of securities that are both sound and more attractive than the average, expecting a better average return than the passive investor. Who are you? I think I don't know. I think it really depends. If I'm really interested in something, then I'm really interested, and I'm probably also gonna take more action, I guess. But if it is something that I'm not that interested in, I do think that it is smarter to be passive and try to make as less mistakes as you can, and to not just be risky, as you possibly can. I think it just makes sense. Well, yeah. For both types, Graham emphasizes the virtues of a simple portfolio policy, the purchase of high-grade bonds, plus a diversified list of leading common stocks, which any investor can carry out with little or no expert assistance. Let's explore the two types of intelligent investors. A little bit of a primer here. Please let me just thank you. I do think we are gonna go through the defensive investor and also the other one, and so just in general, I think gonna go ahead with the summary the next time. But I do want to have a look at himself, Benjamin Graham. I do just want to have a look at his Wikipedia article. It's probably going to be I do assume that it is a longer one. So let's see. Okay. Whoa, what the fuck? There's a lot of references, but there's not a lot of text, but there's a lot of references. And he also wrote 1, 2, 3, 4, 5, 6 books, of which the intelligent investor is the funny thing is the intelligent investor was the first edition was published in 1949, then it was reprinted in 2005, 1959, 1965 and 1973 with many reprints since. Nice, really nice. So he was born on Benjamin Graham Grossbaum or Grossbaum. It basically means it is just Germanish, I'd say, and Grossbaum would mean big tree. Baum is tree and Groß is big or also tall. It depends on how you're using it. But he was born on May the 9th, 1894 and died September the 21st, 1976, was a British-born American investor, economist, and professor. He's widely known as the father of value investing and wrote 2 of the founding texts in neoclassical investing, Security Analysis with David Dodd and The Intelligent Investor. His investment philosophy stressed investor psychology, minimal debt, buy and hold investing, and fundamental analysis, concentrated diversification, buying within a margin of safety, activist investing, and contrarian mindset. Really, really, really interesting. And what we can see there is that we can also just go through this one, and then that's quite gonna be it for we don't even have to have the book or something, because they also have them, activist shareholder is a shareholder that uses an equity stake in a corporation to put pressure on its management. What the fuck? Is this something real? No? I mean, of course it is something real, but I do wonder how many people are doing this. Because I know, I can understand it, but, So after graduating from Columbia University at age 20, he started his career on Wall Street, eventually founding the Graham Newman partnership. After employing his former student Warren Buffett, he took up teaching positions at his alma mater. I never ever know how to pronounce it. And later at UCLA, Anderson School of Management at the University of California in Los Angeles. His work in managerial economics investing has led to a modern wave of value investing within mutual funds, hedge funds, diversified holding companies, and other investment vehicles. Throughout his career, Graham had many notable disciples who went on to receive substantial success in the world of investment, including Arvind Khan and Buffett. They're later going on to describe him as the second most influential person in his life after his own father. Once again, both would name a child after Graham. Another one of Graham's famous students was Sir John Templeton, British investor, baker, fund manager, and philanthropist. He entered the mutual fund market and created the Templeton Growth Fund. In 1999, Money magazine named him arguably the greatest global stock picker of the century. And Arvind Khan was an American investor and philanthropist. He was the oldest living active investor. He was an early disciple of Benjamin Graham, who popularized the value investing and blah, blah, blah. Whoa! He was born 1905 and he died 2015, unfortunately, at the age of 109. And he actually doesn't look that bad, to be honest. Like, really not. Like, of course, he doesn't look like 20, but that's not something that we're expecting. Really cool. I enjoy that. Khan, his sisters, and his brother were collectively the world's oldest living quartet of siblings. Khan himself lived to 109. His sisters, Helen Reichert, nicknamed Happy, died 7 weeks before her 110th birthday. The youngest sibling, Peter, Peter Kane, died at the age of 103, and Kane's other sister, Lee, died at the age of 101. Kane outlived his son, Donald, who died suddenly on January 16th, 2015 at the age of 79. Arvind Khan died on February. His death was reported through a brief obituary in the New York Times on February. No specific cause of death was given. Well, I do want to point out that it must be something that's really, really, really bad if your son dies before you. I mean, like, 80 is fine. I would argue. I know 80s. I mean, like, of course, we're gonna live for longer, probably. I'm gonna live for longer, probably, because medicine is gonna evolve. A lot of things are gonna evolve. But I mean, like, yeah. I mean, like, also 79. Like, it's not that old, you know? But it is pretty funny. Helen Reichert. It's a really Germanish name, I have to say. Like, Reichert, as it would be pronounced. Interesting. But I guess that this is going to be the end of the episode. So I wish you the best health, of happiness, and all success. And also hope that you're going to remind yourself and you're going to be remembered how you... Basically means your legacy. And basically means just being a nice person. And then being also remembered as a nice person. The 3 R questions that I'm having for you are: why are you here? What are you trying to change? And what is bothering you the most? These 3 questions are hopefully going to show you your purpose and hopefully also a business idea. And yeah, that's it with me. I can't unfortunately end the episode because I'm having my fucking rainbow bread? Rainbowish thing turning around here. So, yeah. I think it is a pretty interesting thing. And I also think it is something relatively valuable. I'm sorry. But I also have to say that it is something that's quite interesting to see that it is still, like, relevant. Yeah. That it is still relevant and that it still is something to consider. Yeah, you know. But it's just, I mean, this just illustrates how much you can actually change the world after you've died as well. You know, if you have just been able to build something that's amazing and it's gonna live basically forever, as this thing is definitely gonna, because I mean, Warren Buffett is probably also having some quote unquote disciples, or at least people that are working in his company. Is there actually something? Warren Buffett disciple. Maybe it's gonna be like, okay, it's a disciple of Benjamin Graham. 2 Buffett disciples tell you how to make it big on D Street. Investment veterans Monish Popre and Guy Spear had once spent $6.5 million for just one lunch with billionaire Warren Buffett. What the fuck? This is a lot of money. Or it is 6,000. I don't know. There's just cut off the whole thing. I think it is 6 million for just one lunch with billionaire Warren Buffett. Not without reasons. Both, the two of them who believe that value investing is timeless and it pays to get a grasp of the value of the business and where it is heading in the long term, have been big followers of the legendary investor. In an interaction with ET Now's Tanvir Gill, they opened up on how one should deal with markets under any conditions. Take Baprai, for that matter, value investing is timeless and will be here for the next 50 years, he said, citing the example of Rain Industries. For those who track the shape's price on a day-to-day basis, Spear said checking the stock prices regularly does not make sense. Yeah, I don't know. It might just be influencing you in some way. But yeah, kind of, at least. It is like a really, I'm sorry, not a beautiful website, I gotta have to say, but I'm not here to want to judge. 2 Buffett disciples tell you how to be big on the same one again. Here are the 3 big name Buffett principal disciples investing. Blah, blah, blah. Berkshire Hathaway, Sears Holding, Hogwarts Hutches, Whitney Tilson, who runs New York-based hedge fund Case Capital, has made a name for himself shorting hardwood flooring manufacturer Lumber Liquidators since publicly announcing the position in 2003, a move that Buffett, who Tilson credits as of his biggest inspirations, might not approve of. Charlie and I have both talked about it. We probably had 100 of ideas of things that would be good short sales, Buffett said in a 2012 interview with the New York Times. Probably 95% of them at least turned out to be, and I don't think we would have made a dime out of it if we had been engaged in that activity. It is too difficult. Okay, sure, like something. But yeah, now I can end. I'm gonna see you the next time. Bye bye.